Good morning and welcome to the Market Matters webcast. Thank you very much for joining us this Tuesday, the 19th of April, 2016. My name is Sam Torpey and today I'll be joined by Nicholas Forsyth, Director and Head of Distribution here at Market Matters, based here in the Sydney CBD. Before I introduce Nicholas, I'd just like to make a small disclaimer. Today's information and presentation is for general education nature only and does not constitute any personal financial advice. Before making any investment decision, we recommend that you consult a professional advisor. Today, we would like to talk to you about how the professionals are going to play the market. I'm joined now by Nicholas Forsyth, Director at Market Matters. Good morning, Nicholas.
Good morning, Sam, and good morning everyone that's come along, taking time out of their busy days to attend. We're very excited to present the information to you today. It's coming into a very choppy time in markets, and we think that coming into this time, knowledge is power, and we're really looking forward to getting stuck in. So let's kick things off, Sam.
So Nick, this time of year is usually choppy for investors. We've all heard the saying, sell in May, go away. Where do you see the market heading?
Well, Sam, that's a great question. But before we have a look at 2016, I thought what we'd do is have a look back at 2015 and what we did at Market Matters relative to the market. Now, as you can see, we have a chart here of what the ASX did last year. Started the year at 5,400 and finished the year actually lower than that point. Now, as you can see at the top here, the market formed a triple top and tried to break through 6,000 on 3 separate occasions and actually failed to. Now, at Market Matters, we did a lot of selling into that strength. And the reason why we were selling is not because not because we owned bad stocks, but more because we were managing risk for ourselves and for clients. So the reason why I've got this chart here is I just want to set up what we're about to talk about and what we think is happening moving forward. Because as you just touched on before with that great question, we are heading into May, which is historically a choppy time for equity markets at the moment.
Now we have a chart of the ASX for 2016. What are Market Matters seeing? And do you think there'll be a repeat of last year in terms of a pullback?
Sam, thanks for the question. What we are seeing, I'm going to break down into short-term and medium-term. Now, one thing to bear in mind is Market Matters is currently at 29% cash. Now, that is a pretty high level of cash, but we are also looking to go to higher levels of cash. Why have we not sold more stock? The reason being is short-term, we think the market can get towards 5,400. What is going to drive us there? We think this weakness in the US dollar and this bounce in commodities can push our stocks higher, along with one final kick in financials. So short term for the ASX, we are targeting 5,400, which is around about 180 to 200 points higher than where we are currently at. After that point in time, we will turn quite bearish, and we think seeing 4,500 or below this year is a realistic probability based on the lead that we are seeing from the US, which we will talk about in the next slide.
Well, here is the chart of the S&P 500, which is a reflection of the top 500 public companies in the US. Nick, historically, this has been a good indicator for the Australian market. What are you and Market Matters seeing in 2016?
Thanks, Sam. Well, historically, we've looked to the S&P for a lead on where the ASX is headed, and we are getting a relatively clear indication from it of late. Now, what we're seeing on the S&P is we're predicting one more move higher. Now, most bull markets have 5 waves up, and for the S&P to make new highs above 2135, we need to see some decent data. We also need to see some optimism. Now, based on the recent run, which has also led to a bit of a run in the Australian market of over 400 points recently, we are seeing this. But what we feel is after making new highs, we think exactly what has brought the markets up to this level will be what takes it down. And it will be people losing faith in policymakers, or conversely, it will be the rate hikes that have been well telegraphed and talked about. And we think this is what could lead to quite a substantial correction in the US sometime later in the year, which we in turn think will provide some good buying opportunities and is not something that should necessarily be complete, where people shouldn't be running for the hills, we don't feel.
Nick, turning back to the Australian market, it's quite common that investors focus on income and dividends during a pullback. Does Market Matters take a similar approach?
Well, Sam, what I'd say to that is divvies are great. However, we have never fallen just in love with dividends here. And there's a few things we're conscious of when identifying a stock that pays a good dividend. Now, the chart that we've got here, courtesy of Macquarie, highlights two things. First of all, on the left-hand side, you've got dividends as an aggregate of profit, and on the right-hand side, you've got profit as an aggregate of capex. Now, two things to bear in mind here. Stocks can pay out a lot of, or companies can pay out a lot of their money as a dividend, and you'll get a nice tidy dividend on an annual basis and you'll be quite happy. However, where the red flag is there potentially is if this is a recurring trend and companies continue to do this, they are not holding back money for further capex, which can in turn lead to future growth. Now, if you do not have future growth, you most likely do not have the capacity to pay a dividend of the same size down the track. So what the most likely occurrence is dividends will potentially fall. Now, what I'd like to touch on next is the Australian banks, which most people listening today would own. So Sam, let's go to the next slide.
Nick, here we have the payout ratios of the big four banks. Can you take us through some of these as an example?
Yeah, of course I can, Sam. Now, what we've got here is the proportion of earnings from the big four that is paid out as dividends. Now, as you can see, you've got CBA, ANZ, Westpac and NAB here. Now, we've got this target band for all of the big four, which is the target payout ratio set out by management. Now, as you can see, CBA has always fallen within that band, and they did report recently and showed great capital management in not increasing their dividend drastically to keep investors happy. Now, that's why we hold CBA. That's why we'll probably continue to hold it. And that's why we've always been happy to pay the premium to own CBA relative to the other banks. Now, if you look around these other charts here, you got Westpac, which is also in the same target band. Now, Westpac is an Australian bank predominantly. All their earnings come from onshore. And if you wanted something that's probably secondary to CBA in terms of its safeness, Westpac is probably that company. However, the two over on the right-hand side, we've got NAB and ANZ. Now, ANZ has been the one where there's been a lot of speculation around recently. They did come out and report to the market that bad debts have increased courtesy of exposure to the mining space, more than 100 million, taking their total write-downs to 900 million plus, amongst other negative press. Now, ANZ, on the other hand, relative to the other banks, has been pushing ahead with a high payout ratio, and we think their dividend is most at threat, along with NAB, as you can see below. So I guess what we're trying to emphasize with these charts is good capital management is essential to running a business, and if management is not paying out too much money as dividends, it allows them to continue to run their business, hold money back for further investment and further capital expenditure, which in turn can lead to growth down the track. And we are in a very low growth environment, I would add, Sam. So just a quick recap of the big four. Firstly, CBA, we've got the chart here. As I indicated, or as we indicated before, we like CBA because of its payout ratio, and we do like it over the longer term, and we will continue to hold CBA in the portfolio for now, although we are not buying any more at the moment. ANZ, which has been the most oversold recently due to its exposure to the mining space and its exposure to Asia. We do have a small allocation towards ANZ. We do think their dividend is most at threat longer term. It's probably the bank with the most going on at the moment. Similar view to CBA though. We're not buying more at the moment, although we do expect it to go probably slightly higher. Westpac is in a very neutral pattern at the moment. They have showed good capital management along with CBA recently, and they do have all their earnings predominantly coming from Australia for the risk-averse investor who doesn't want to go offshore. However, as I said, it's very neutral at the moment. NAB has finally got rid of its non-performing UK asset, being Clydesdale Bank, and that is now a separate listing on the ASX. NAB is also neutral in our opinion. Its payout ratio is slightly high, and technically is not showing us anything or any real reason to buy it. But just to highlight the Big Four as a group and tie it into our short-term market view, short-term we think the market's going to 5.4. This would mean that we are predicting 4% more upside through the Big Four banks. However, banks like ANZ, which have been a lot more oversold than the likes of CBA, we would expect maybe a 6% bounce, which would be slightly more than CBA, and we would say that they'd probably offer more risk reward, but as the title says, risk reward, meaning that the reward does come with more risk.
Thanks, Nick. Just wanted to remind all of our viewers that if you do have any questions, please email us at info@marketmatters.com.au. And just a reminder, all information today is just general and it does not constitute any financial advice. So Nick, let's head over to China now, where we've got the Shanghai Composite chart. Where does China fit into the Market Matters analysis?
Well, Sam, in terms of China, the thing about China, people only really stand up and take note of China when there's a panic sell, and that leads to volatility in markets. The rest of the time, no one really cares what's going on. Now, you've also got to look at the composite of the market. It's a lot of, what was a very small proportion of the population, and it's almost like a casino. So in terms of looking at the Shanghai Composite, the same way that we look at something like the S&P for a lead, it doesn't come in to the equation. However, we do take note of it from time to time as more of a measure of volatility. If the market is going through a bit of a panic sell, it's a good barometer for that.
Very interesting, Nick. So how would Market Matters take advantage of a market like China?
Okay, Sam. So if you go to the next slide, first of all, we've got iron ore. Now, iron ore has had a really good bounce recently off its lows of 38.30, and it has now actually hit our price target of 60. Now, what we think with iron ore is short term, it is presenting some really good buying opportunities throughout the space, which is oversold. One thing firstly, though, we've got to bear in mind is GDP in China has now dropped below 7%, and the trend has been down for quite some time now. So longer term, we think investing opportunities are not quite there. However, short term, there is a lot of opportunities. Now, earlier on in the year, we brought Fortescue Metals at around about the $1.50 mark and sold it out at $2.40. It's since gone higher, we know, but we were happy to take profit. We bought some Rio at 38 and we sold it at 45. It's gone higher, we know. Also as well, BHP's done well for us. Now, this was on the basis of iron ore being oversold relative to the market, and we were anticipating a bit of a bounce based on the technicals and also some of the fundamentals based on the fact that GDP in China is still around 6.7%, even though it's retracted off a very high base, mind you. The population has grown. So iron ore has been one of the ways we've taken advantage of the China story, but it is a very volatile space, and we have only done it with certain portions of the portfolio, not our core holding. Okay, Sam, also next, if you flick to the next chart, we've got the Bellamy's chart here.
Nick, can you just explain to a lot of people listening a little bit more about Bellamy's and what it is they do?
Now, what Bellamy's predominantly do is manufacture infant formula. And over the last couple of years, there has been massive demand coming out of China, which has driven the growth in Bellamy's. Now, I guess what the chart here emphasizes is how China can be a risk and an opportunity, which is the actual title of the slide. If you look at Bellamy's recently, it pulled out a high of $16.50 and it actually came all the way back to $8.63 or around that point. Market Matters has since purchased this stock on anticipation of higher prices and thinking that the selling is overdone. Now, the stock is not cheap. However, we think moving forward, there is potentially money to be made in Bellamy's, and it is a great example of the China story and what the China story means to certain stocks and the actual size of the population, the potential demand coming out of China as their middle class looks to improve their standards moving forward, and the rising affluence of the Chinese consumer. Bellamy's is tied right into this. There is also multiple other stocks in the ASX which we are looking at, which are on our radar that we may enter into at other points in time, but Bellamy's is one that we have purchased recently.
Nick, Bellamy's is a very lateral way of taking advantage of the China story. But what about investors holding stocks that are heavily exposed to commodities?
Okay, Sam. Well, firstly here we've got the commodities index. Now, as you can see, the commodities index has had a massive bounce since the start of 2016, almost since the very start. Now, the commodity index is made up of a lot of things, including the likes of copper, iron ore, and even energy, for that matter. Now, at the start of the year, Market Matters did predict a bit of a bounce in this space across the board on the back of a weakening US dollar. Now, we think this move, and part of the reason why we thought this would happen is this chart looks awfully like the emerging market index, which we were predicting a bounce in, if you ever want to look at the two together. We cover this quite a lot in the weekend report, mind you, if anyone wants some light reading on this. But based on all this, we still have a relatively bullish view on some stocks in the commodities index and some stocks that a lot of investors would hold in their portfolios. First of all, I'll kick things off with BHP. Now, BHP is probably the most inherited asset here in Australia through people's super funds, whether they're in an industry super fund or a self-managed. Now, the good news for investors holding BHP is Market Matters is relatively bullish short-term on BHP. Although we're not coming out and buying it today, we have bought it in the past around the $14 mark, and we did sell it at about $17.50. So we're not buying more today. Although we didn't buy more or are not buying more, today it's about $18.40, $18.50. We're bullish for stock, and we're targeting a short-term target of over 21.20. And the chart is setting up great for this, and this looks quite likely. And also as well, if you look at the commodities index, this looks like it is a potential thing to happen. They are coming out with their production numbers over the next couple of days, so that should be interesting as well. The next one we've got here is Rio Tinto. Now, as we've said, we've been in and out of this stock, like BHP and Fortescue, towards the start of the year, so we don't currently hold this stock as a disclaimer. Short term, we think Rio, I will add, will move higher with BHP. However, we're not as optimistic on Rio. They also did release their production numbers this morning, and they were at the lower end of consensus. Actually, they missed. At a glance, we obviously haven't had much time to read it, as they only came out an hour or so ago. But, we are still optimistic short term. We think these stocks can move higher short term in line with our bullish market view. Okay, and the next one we've got here is an energy stock. A lot of people hold a bit of energy in the portfolio, whether it's Origin, whether it's Santos, whether it's Oil Search, which we've got here, or whether it's Woodside. Now, Oil Search is one of our recent buys from around about the $6.20 mark. Now, we are targeting the high sixes for this stock. We hope that we can get $7, but we are targeting the high sixes. Now, the reason why we like Oil Search is one of the lower cost producers out there. Oil Search cost of production is way down in cost per barrel of around about the $18 to $20 mark, whereas competitors in the space, the likes of Santos, is up around 40 or 50, and additionally to that, Woodside is up in the 40s as well. So we're a big fan of Oil Search. We've been in and out of it a couple of times. We were in it towards the end of last year for an improved takeover bid from Woodside Petroleum, which we didn't get, but we still moved out and made some money. And we've since moved back in the recent days into this stock. Now, investors watching this, we still like Oil Search, although probably the risk reward has gone, given it's already bounced from 620 to around about, I'm not sure what the recent price is, but it has already had a bit of a bounce. So I guess resources, stocks leveraged to China, we expect a little bit more upside short term, but we wouldn't be chasing it.
So Nick, we all know that the Australian dollar has an impact on commodity prices. Where does Market Matters see the Australian dollar going before the end of the year?
Okay, so the Aussie dollar, Sam, has had a really, really good bounce off its 68 cents lows, which was towards the start of the year. Now, this bounce in the Aussie dollar has mainly been due to weakness in the US dollar. Now, short term, we would not be surprised to see an Aussie dollar around 80 cents relative to the US dollar. Now, we think that the further weakness in the US dollar will continue to occur, and what will then happen is either one of two things. Firstly, the RBA may be forced to act, and Glenn Stevens, who is leaving his post sometime this year, will obviously try and jawbone the currency, which means talk it down in a bid to see it weaken against the US dollar, because Australia needs a weaker Aussie dollar, and that could have a negative impact on the currency. The other thing that could drive the Aussie dollar down could be a rate rise in the US. Now, we've already seen one rate rise in the US, and Janet Yellen, the Chief of the Federal Reserve, has indicated there will be more. And at the last time the Federal Reserve met, only a few weeks ago, apparently, based on the minutes of that conversation, another rate hike was potentially on the table. Now, we think short term, as we've said, 80 cents is a legitimate possibility, but longer term, that these two things are likely to impact the Australian dollar, and you'll see a weaker Australian dollar on the back of this. Now, that means that our target by year's end would be back below 70 cents on the Aussie dollar. Now, next slide now, Sam. What I've included here, or what we've included here, is Regis Resources. Now, this is another commodity-based stock. Now, one thing I just want to add quickly is it is not necessarily correlated to this strength in the Aussie dollar, although they do produce in Australian dollars. Now, we've included this because Regis is our favourite stock in the gold space. Now, if we look at recent price action, it's had a really good run from $1.07 in 2015 all the way up to $2.93, and has since been consolidating in a bit of a sideways pattern. Now, Market Matters were lucky enough to pick this up recently at about $2.40, and the stock is now slightly higher than that today. Now, we do think we'll see $3 on this stock in the not-too-distant future, and we would be happy to buy more of this stock if we did see lower prices. Now, the reason why we like Regis, and this is one of our favourite picks at the moment, is there's no real skeletons in the closet where there was historically, and that's what led to the the stock to go from $4.37 all the way back to $1. And so no real skeletons in the closet. Also has a 6-year mine life. They put out their production numbers last week, and they came in at the top line of consensus, and cash costs per ounce did drop quite considerably. And these are all the things that you look for by buying a gold company. So we'll be happy to hold Regis even into a slight correction in the gold price, because in line with our view on gold, we think gold is moving higher over the longer term. Now, the next slide, Sam, if you could just go to the next slide here, is the gold price. Now, as you can see, the gold price has had a really, really good run up from the start of the year and has actually broken out of its long-term bear market, where it's come all the way back from 1921 and 2011 all the way back to close to 1,000. Now, we've seen a really good run of about $185 on the spot price. Short term, we're 50-50 here on the gold price moving higher, but long term, we're bullish. And we think gold will move higher over the medium to longer term, in line with what we came out and said at the start of the year, that we think gold could rally $200 or $300 this year. Mind you, it was already rallied over $180 over a short period of time. So we think that short term it may consolidate, but long term we are bullish, and we're happy to own gold stocks almost as an investment for the first time in quite some time, probably since the inception of Market Matters.
Okay, great. And what else is Market Matters looking at as well for stocks that they like?
Okay, so if you flick over to the next slide, Sam, what have we got here? We've got the QBE chart. Now, to be honest, QBE has been a bit of a nemesis of Market Matters since inception. We've fought some fierce battles with QBE. But the reason why we like QBE fits perfectly into our macro view. However, one thing to bear in mind is we're not buying it today. So investors listening, it's definitely one for the watch list. If you owned it, we wouldn't be selling. But if you didn't own it, we're not saying rush out and buy it today. But the reason why we like QBE, as covered in the most recent weekend report put out last Sunday, is if our macro view is correct, and the Aussie dollar does peak out at around 80 cents, is what I said before, 80 cents, and then retracts from there, this will be great for QBE, who hold a lot of money in fixed interest in the US, the bulk of their money to meet financial obligations, being an insurer. There is also relatively new management in the company at the moment. Historically, old management hasn't always done well to keep shareholders happy. And additionally to that, any potential rate hike in the US, which we alluded to before, is incredibly beneficial to QBE's bottom line. So in line with our macro view, which we've got quite a firm one at the moment, what we're seeing this year, we think QBE fits into that quite nicely, and that is well worth keeping your eye on over the short to medium term.
Nick, as you indicated at the beginning of the webcast, 2015 was a very good year for Market Matters. It wasn't just the stocks that Market Matters bought, but it was also the stocks that Market Matters avoided or sold. What stocks will Market Matters be avoiding in 2016?
Okay, Sam. Thanks for your question. Now, I guess, as you indicated there, the beauty of the service is sometimes we'll tell you what stocks to avoid or to stay away from. We get a lot of questions from investors asking to buy certain stocks at certain times, and even though we may not hold them, we may have a view on them. And I guess that can really help investors piece together this market, which is incredibly choppy. Now, a couple of stocks last year that we recommended investors sell. Firstly was Woolworths, around the $35 mark. That currently today is around about 22, 23. The other was BHP, around the 38, 39. Although we did move into it in the low 20s and bought it again at 14, we were very, very bearish on BHP all the way through the 30s and through the high 20s. So, as indicated, the benefit of the service can also be what stocks to avoid. Now, in terms of actual conviction sell, we don't have a lot for you today. As indicated also as well at the start of the webinar, we do think the market goes to 5,400 over the shorter term. And given we're not quite there yet, all we've got is some stocks that we're thinking about taking off the table at the moment. The first is Amcor. Now, they've had a phenomenal run-up since 2011. Bit of a defensive industrial box manufacturer. They have hit what we had as our price target of $15. We are now neutral to negative the stock. So investors that hold it, we're of the opinion that maybe it's time to run a tight stop or maybe it's time to sell out some, although we don't own it officially for market matters. And this is just an example of when the markets get to these points, the savvy investor is generally taking a little bit off the table in a bid to bag some profits so he can outperform the market at the end of the year. Now, Sam, if you just go to the next slide. Okay, the next slide we got here is REA Group. Now, REA Group has done phenomenally well over the last few years, come all the way from $10. Now, this is another one. We think, just like Amcor, we believe profit should be taken around here. Why? It's a high PE stock. If we do see a correction, which is our view, stocks that are trading at very high PEs usually get crunched. So the nimble, the savvy investor is usually taking profits around here. Also as well, REA as a business is moving from a subscription business to a volume-based model. And we have indicated our view on the property market in the past is that we are due for a slowdown, not a capitulation, but a slowdown. And companies like REA, would not be immune to this if we did see the market slow down. So just to recap, two stocks here, REA and Amcor, both ones that we're not super bearish on as such, but we would be looking to move out of or at least take some profits if we did own them at this point in time.
Well, that's great, Nick. Thank you very much for your insights today. And thank you, everybody who joined in our webcast. We'd just like to remind anybody that if you do have any questions, please contact us at info@marketmatters.com.au and we'll make sure we get back to you as soon as possible.
I echo Sam's thoughts. Thanks, everyone, for attending. We did have a lot of questions come in. What we will do is we will address the ones that we haven't had a chance to cover via email or over the phone. And thanks a lot for everyone's engagement. It's been fantastic. Everyone have a lovely day.